Well, I think that we're in the midst of what I would call a melt up. So, probably the next month and a half, there really isn't much quote unquote bad news that hasn't been priced in. The thing that I've learned over the last few years is that markets don't actually care what the news is. They can process good news and bad news equally well. What they despise is the uncertainty of what the news could be. Where are we going from here? Probably up.
Chamath Palihapitiya believes that the majority of bad news we have seen across the start of 2022 is over, and his advice to investors is that it's time to start buying. Chamath famously pulled the trigger on some big sell calls towards the end of last year, which he received a lot of flack for, yet in retrospect were definitely the right calls. In his latest podcast, he explains why now is the time to be buying up and why his sentiment has now switched to bullish. Make sure to stick around to the end of the video where Chamath's co-host and technology investor David Sachs argues against Chamath and believes that more bad news is on the way. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
This week was really important because we had two huge buckets of uncertainty taken out of the market. So the one we've already talked about, which is when the market saw that there was a surface area of a deal between Ukraine and Russia that was really constructive, because neither side would have signaled something if both parties were very far apart. So that meant to the markets, we're a few weeks out from something getting done. And then the second thing was Jerome Powell and the Federal Reserve. They finally had their meeting. They raised rates 25 basis points. But even more importantly, they gave you a very prescriptive forecast of what the next year will look like at a minimum, and possibly even 2 years. And once you could have that, you were able to then go and redo all of your expectations. And what people realized was, okay, inflation may actually start to get tamed in the back half of the year. The economy is still quite strong. And we could actually support 2.5% interest rates and still actually grow really well. And so what you've seen in the last 3 or 4 days is a reaction to the loss of uncertainty. And so there really isn't, the only thing, the fly in the ointment could be if the war all of a sudden escalates. Not that it gets dragged on, because at that point that's also, I think, been priced in. But if something very meaningfully different and Russia in this case ratchets up the intensity by going, nuclear or something else, although I think that's a very long tail.
Chemical weapons seems a possibility, or carpet bombing.
I think these are all very, very low probability events. But in the absence of these things, you basically have really constructive dynamics right now for at least the next month and a half, maybe even 2 months.
How much of this has to do with retail investors who were YOLO, hodlers, speculators, stimmy checks, getting super active for 2 years and then maybe getting super spooked right now and maybe needing the money to deploy in their lives?
Look, the thing to remember, and I hate to be this blunt, but it's true, retail is not a very good signal of anything. In fact, if you actually look at retail flows, typically you will make money by doing the exact opposite of what retail does. And I posted this in the group chat to you guys. Every single day of since the beginning of this year, retail was a net buyer. In all of those days, the market got punched in the face. Finally, at the beginning of March, retail capitulated. Right? And I posted that same day and I said, guys, this is the moment to buy. And lo and behold, what happened? The markets rallied meaningfully from that point. And the reason is because they were going into the end of Q1. You have a huge tax bill due in April 15th. People were starting to just finally give up. They were buying every single day and they finally gave up. But that capitulation was the moment that you buy. So if anything, retail is the, I've said before, you fade your fade list. Retail flows are something you typically will make money by fading, by doing the exact opposite of whatever retail is doing. And you just need to have access to that information. If you have access to it, you can kind of, profit from it. So where are we going from here? Probably up.
So there's Chamath with why he believes the majority of bad news has been priced in and it's time to start buying. However, his co-host and technology investor David Sachs did not share the same viewpoint. Here's why he believes there's more pain to come. But before that, one topic Chamath and the hosts have been very vocal about is stagflation. That's a scary word, and what it means is even scarier. For those that don't know, stagflation is an economic situation in which the inflation rate is high whilst economic growth rate slows. With inflation soaring to 7, 8, maybe even a whopping 9%, a global crisis and top firms predicting returns under 5% stock returns until 2035, the threat of stagflation is very real. But what does this mean for us? Restructuring your portfolio has never been more difficult or more crucial, so where can you turn? Well, you all know that I've been advocating for alternative asset classes for years and they've done pretty well for me, and it seems like people are catching up. A recent JP Morgan report declared alternative assets are no longer optional. In light of this new normal, certain platforms have arisen, giving access to the top alternative asset classes. There's one in particular that seems like a no-brainer to me, and it's called Masterworks. Masterworks.io has solidified itself as the platform for investing in contemporary art. They let you access their exclusive investments from names like Banksy, Monet, and other iconic artists for just a fraction of what billionaires pay to purchase. Because roughly 2/3 of billionaires allocate between 10 and 30% of their overall portfolio to art, in part to diversify and because it's a natural inflation hedge. It makes sense, after all, contemporary art prices outpace the S&P 500 total return by 164% from 1995 to 2021 and have exhibited the lowest correlation to equities of nearly any major asset class. Since 2020, Masterworks has sold 3 paintings, with each returning over 30% net IRR to investors, and their new offerings usually sell out in hours. Here's how they do it. The Masterworks research team analyzes over 60,000 data points to find financially attractive works that they believe will appreciate in value. Then, Masterworks acquires paintings ranging from 1 million to 30 million and securitizes them by filing a public offering with the SEC. It's that easy. If you want to get in on it early, all you have to do is go to masterworks.io, create an account, check out what they have, and invest in their offerings. And my subscribers get to skip their waitlist at the special link in my bio. But for now, here's David Sachs with why he disagrees with Chamath and why he believes more bad news is coming for markets.
I think that there's going to be a trickle-down effect of what's happened in the market to privates, and the valuations are going to go back to their pre-COVID levels. I mean, ARR multiples pre-COVID were like 20, not 100. So we're seeing a massive repricing of deals, and that's going to continue. And I don't think it's just going to be this like transient effect. Everything's going to bounce back in a few weeks. On the public markets, the defining characteristic of these markets is volatility. I mean, the VIX, which is the measure of volatility, is at one of its all-time highs. And so it's true that over the past week, we saw a nice sort of melt up or rally because there was speculation about this peace deal. The Financial Times had that article on the 15-point plan. Chamath is right that if that peace deal gets signed, I think the market rallies strongly because, it went up considerably just on hopes that it might be signed. But on the other hand, if this peace process falls apart, I think the market will give back all those gains and then some. I think we are nowhere near out of the woods on all the risky scenarios that could develop from this war. I think that if there is no peace deal, I think you can almost expect Russia to escalate in the war. They have said this is an existential issue for them. I think that would mean at a minimum, heavy bombing of Ukrainian cities, and then that will step up the pressure even more on Biden and Washington to get militarily involved. This situation could still spin out of control. So, I think in the absence of a peace deal, and then finally we have all the risks of recession, we definitely are seeing a slowdown in the economy right now. And I think if this war continues and we don't get the spring planning and things keep, deteriorating, I think we're headed for a very serious recession in this country. I think we'll go from slowdown to recession. So if I were advising Biden, of course, no one's listening to me, but if I were advising Biden, I would be telling Biden, listen, Mr. President, we are going to have a horrible midterms in November, and, we are going to have a really hard time in 2024. If this war continues and, we head down into recession, or any of the other catastrophes that could happen. We need to push for a peace deal right now.